Paul Kedrosky is a Bloomberg contributing editor and the author of the business blog Infectious Greed. He calls Groupon a multi-level marketing scheme and gives the company just 1 year to live. He joins us from San Diego. Also joining us from New York is A.B. Mendez, a senior research analyst at private equity firm Greencrest Capital. His firm advises clients on pre-IPO private companies and says the opportunity for Groupon is massive. Okay, A.B., wait, let's start with you. Did you really buy an Old Navy Groupon yesterday? Old Navy? Really?
I actually bought the deal. Bought my first deal in October of '09 and actually bought the $10 Groupon for $20 at Old Navy yesterday.
It is easy to look at this deal and criticize it, look at the massive losses, look at the big marketing spend, and look at the size of it. But there's something you like a lot about this business. What is it?
What I like about the business is the size of the opportunity, which if I were an investor, I would expect the company to invest heavily in marketing and building up a technology base that's defensible, a patent portfolio, which they don't have yet. But what I like about the company is the growth, 15-fold year-over-year revenue, as Julie mentioned, and the opportunity in front of them as they're rolling out the mobile location-aware service is only getting larger. And I'd like to talk about that a bit if we have a minute.
Yeah, we'll get there. Paul, I want to bring you into this, too. So you're saying AB's crazy, huh?
Yeah, I don't know personally, but about Groupon, sure. I mean, I'd point to all the same things that he does with respect to Groupon, but I come to the opposite conclusion. Like, for example, they're spending heavily on the business, much like Amazon did, and with many of the same criticisms that Amazon got, a decade plus ago now. But the difference being that it's not obvious what the defensible barrier here is with respect to Groupon that Amazon was building. Amazon was building warehouses and logistical systems, which we all criticize them for, but that turned out to be the moat, right? The defensible barrier between them and their competitors. With Groupon, it's really not obvious what that is, and it's certainly not customer loyalty. If you look at even the numbers that Groupon disclosed in the S1, using a case history of one of the early cities they were in, like Boston, you see that customer acquisition costs are actually rising again. It's not that they've got such immense loyalty with early customers that their early users become a moat. So it's really not obvious what the defensible barrier is here. It just looks like an example of how you can spend a lot of money to make a little bit of money.
But Paul, what about the sheer numbers of users? I mean, surely you're impressed, at least on some level, by the immense increase that it's seen in users just over the past year or couple of years.
Yeah, I mean, it's hugely impressive, but not that much more impressive than if I started selling dollars for 50 cents. People love a bargain, and so not surprisingly, you're going to get a huge flood of people, and this is the right model at the right time. But that doesn't prove out the model. It just proves that if I can bring a lot of users if I sell stuff for half off. Big surprise.
So, A.B., let's bring this to you. What keeps the Groupon customers from going elsewhere if anybody else can pretty much duplicate this model?
So the standard desktop and email model can be duplicated. What Groupon has done a great job of doing is just innovating with the structure of the deals, not just the technology, but the structure of the deals. I got an offer for, I can go to either the pro baseball game or the pro football game in my area, plus a meal package. What will be a true defensible moat, if you will, is the Groupon Now platform, which they said, having been live in Chicago for a couple of weeks, allows them to deal with over 1,000 local merchants at one time. Normally, they run about 20 promotions per day in the Chicago area. That's about 3% of their overall nationwide North America deals. So if you take 1,000 concurrently on the Groupon Now platform in Chicago, you extrapolate that nationwide as they're gradually rolling out New York and San Francisco this week and continue the North America rollout. They could be doing concurrent deals with over 15,000 merchants at one time. So as that becomes a technology moat or some defensible intellectual property, that becomes sort of the secret sauce if they're able to execute against that opportunity.
Hey, A.B., there's a lot of talk in the prospectus about the ability of Groupon. They say their moat is their ability to target promotions to people who want the exact promotions they're getting. But, I've been a competitive swimmer for 30 years. This morning they asked me if I wanted to take swim lessons in a city 20 miles from my house. They don't seem that targeted to me. Do you see that as a defensible moat for Groupon as it exists, or just something a moat that they need to dig?
The targeting is far from perfect, Corey. If you look at the targeting of ads on Facebook 2 or 3 years ago versus the targeting now, it's remarkable, the change and the improvement that you've seen over time. I noticed that Groupon hired MicroStrategy earlier this year to help them with some of their data mining and data analysis. I think they're beginning to get very serious about analytics and about honing the algorithm for targeting those. I get a lot fewer spa pedicure Groupon offers today than I did a year ago, so that's a good thing.
Well, your nails look great. I think that that's an important part of our viewers should see. They don't look like this. You look fantastic.
Kind of you to say.
No, but when you look at
the
this
difference
business
here,
I mean, no, to Paul's point, I want to ask about this because, his point of selling the thing, selling $1 for 50 cents. You talk about their ability to go into a new business that they haven't really demonstrated. Is that the only value here?
No, what I will say, Paul was correct in that the cost per subscriber increased in the first quarter of 2011 over the full 2010. But in fact, the cost per paying customer was roughly flat at about $31. So what you can say is if it costs them $31 to bring in a customer, what's going to be key is what does it cost them to keep that customer? They're investing a lot in marketing today because they have a massive opportunity. They've grown revenues 15 times year over year. They've grown users 20 times year over year. These are multi-1,000% year over year revenue growth.
Yeah.
So they're executing against that opportunity. The question will be, just like a Netflix, they spent a lot early on in increasing awareness because there's a massive opportunity in front of them. When they try and bring that down to a more reasonable level of marketing spend as a percentage of revenue, what will the churn rate look like? And that remains to be seen.
Well,
it's up to them.
If you look at the early cities,
are these guys, are these subscribers like cable TV where you get them and you got them and you keep them? Or are they just people who show up for a deal and they'll be gone the next day? Because that's really the question here. Does a marketing dollar spent mean you keep the customer?
Well, and that's the essential bet that Groupon asked us to make when you read the S1. They want to do this thing, the CSOI idea, this consolidated segment operating income idea, where you sort of net out marketing expenses because, that's just an early build expense. Later on, we're just going to have retention expenses, and that's not such a big deal. And I don't buy that at all, and it's certainly not borne out by their experience in Boston and elsewhere in some of the earliest cities they were in. Maybe it'll be different with Groupon now, but then we're asked to buy this entire investment sort of on a wing and a prayer and speculation. So the reality is, from the data that I've seen and from the early studies we've seen done on Groupon's model, retention isn't actually very good. There is a significant amount of churn in the base, so these subsequent acquisition costs are going to stay high, and we're going to have retention costs at least as high or higher than we see today. So it doesn't work that way either.
Paul, thank you so much. We're going to ask you to stick around for another moment. A.B. Mendez, Senior Research Analyst at Greencrest Capital. Thank you so much for joining us to give your analysis.
Paul, blog Infectious Greed, you're a smart investor, and a Groupon skeptic. Some people look at this deal with Jeff Clavier was on earlier, and he loves this management team. He's a seasoned VC. He's backed deals like this. And these guys, I want to run you a quick clip of what Clavier had to say.
To be honest, I'm a bit pissed because I think there's been a lot of really stupid things said over the past 24 hours around Groupon, its IPO, its CEO, Andrew Mason. I think that they've created a brand new company that has gone from zero to $650 million in revenue in the last quarter, which is a crazy growth. They've created 7,000 jobs, and I've heard people sort of compare Andrew to Bernie Madoff.
So, all right, maybe that's strong. He's no Bernie Madoff. But, Paul, what do you think of this deal?
Oh, my God. You know Jeff's French, right? I just think I should introduce that.
No, he's not. He's Swiss.
Oh, right. So here's the deal. So I agree with everything Jeff just said. I mean, Andrew is a fabulous guy, not to mention hilarious, and has done something fantastic here in terms of the growth of the company, the number of jobs they created. But so what? We're still talking about different things. I think we're talking about Groupon as an investment, not Groupon as this wonderful personal accomplishment of Andrew Mason's. So Groupon as an investment is a very different thing. And as an investment, we have to ask ourselves, has the model been proven out? Was it rank cynicism for so many insiders to sell so many shares all the way into this IPO and to be selling in the IPO? Should that bother us? Should we care about how capital intensive this company's model is? And should we care that it looks a lot like a multi-level marketing business in that more than 50% of the employees are in sales? It's not a technology company. It looks more like Avon or Century 21. These are all the things that bother me about Groupon as an investment, as opposed to a wonderful accomplishment in growing a business.
Hey, Paul, I'm curious, though. I mean, is there a bull case here at all that you see? I mean, is there anything Groupon can do to either create the moat, to improve the cost per customer, et cetera, et cetera? Is there something they can be doing differently?
Oh, I like the talk about Groupon now. Unfortunately, that's the sort of thing that strikes me as more defensible. It's got more immediacy in terms of being tied into what people do, but it's not the business. It's not what we're being asked to invest in. It's something that may or may not prove out over time. We got to look at the business as it exists today, as opposed to what it might hypothetically look like down the road. So were we to see that happen, customer acquisition costs decline dramatically, retention costs go down alongside, then I think you start to see something really interesting. And it's the beginnings of a moat. But right now, this is not a technology company. It's a services company, much more like a traditional marketing company, like an Avon, like maybe a Snap-on Tools, which are all lovely places, but are not great investments at these kinds of valuations. And that's the fundamental problem here. You've got to connect the two rather than simply applauding Mason for what he's done. You have to ask yourself, does the business make sense as valued?
That's called business analysis. That's why we love Paul Kedrosky's blog and his contributions here at Bloomberg. So check out his blog at Bloomberg.com. It's good stuff just like that. Paul, thanks a lot.